Topic: Why fear and greed control the stock market. Investor psychology explained. Do you remember the 2008 global stock market crash? Millions of investors panicked and sold their shares, while a small group of smart investors bought those same companies at dirt-cheap prices and later became millionaires. The same thing happened again in 2020 during the lockdown. The market collapsed, everyday people sold everything, but those who invested during the crash doubled or even tripled their wealth in just a few years. So the real question is, why does this keep happening? Why do some people get rich, while others lose everything? The answer comes down to just one word: psychology. In today's video, we'll break down how fear and greed control the stock market, and how mastering your own emotions can turn you into a smarter, more successful investor. Part 1. The two emotions driving the market. The stock market isn't just numbers on a screen, it's powered by human behavior. And the two strongest emotions that move markets are fear and greed. Fear equals the fear of losing money. When the market crashes, the media screams market collapse, social feeds spread panic, and retail investors sell at a loss. Greed, so the desire for quick profits. When the market is going up, people think, if I don't buy now, I'll miss out. That's FOMO, fear of missing out. Every single day, fear and greed push the market up and down. Part 2. Real-life examples. Let's look at some powerful examples. Dot-com bubble, 1999 to 2000. Everyone believed the internet would change the world. Greed drove investors to buy every dot-com stock they could find. Prices went up 5 times, 10 times, until the bubble burst. Investors lost 80 to 90% of their money. 2008 global financial crisis. The housing bubble collapsed. Fear took over. People sold everything. Meanwhile, Warren Buffett invested billions and famously said, "Be fearful when others are greedy, and greedy when others are fearful." COVID-19 crash. 2020 markets fell 30% in weeks. Retail investors panicked and sold. But those who bought Amazon, Tesla, Apple, Microsoft doubled or tripled their money in just 2 years. Part 3. The psychology behind fear and greed. So why do investors act this way? Here are the main psychological triggers. 1. Loss aversion. Losing hurts about 2 times more than winning feels good. 2. Herd mentality. If everyone's selling, we sell too. If everyone's buying, we chase the crowd. 3. Overconfidence. Bias. Greed makes people believe, I can't be wrong. 4. FOMO. Fear of missing out. Watching others make money sparks envy and leads people to buy at the peak. Part 4. The emotional cycle of investing. The stock market follows a repeated pattern called the emotional cycle of investing. 1. Market rises. Hope. 2. Market climbs. Greed. 3. Market peaks. Euphoria. It'll never stop. 4. Market dips. Anxiety. 5. Market crashes. Panic selling. 6. Market bottoms. Depression. 7. Market recovers. FOMO entry. This cycle plays out again and again. That's why most retail investors lose long-term. Part 5. How to control fear and greed. So how do you protect yourself from these traps? 1. Have a plan. Decide if you're a long-term investor or a short-term trader before you put money in. 2. Automate investing. Use 401ks, IRAs, SIPs, auto transfers to stay disciplined. 3. Don't check daily. Day-to-day swings trigger fear and greed. 4. Focus on fundamentals. Buy companies with real value, not hype. 5. Buffett's rule. Remember, be fearful when others are greedy, and greedy when others are fearful. Mastering these rules protects you from emotional mistakes. So now you know, stock markets are driven less by balance sheets and more by human emotions. The investor who learns to master their own psychology is the one who wins long-term. Drop a comment. Have you ever made a bad investment decision because of fear or greed? And if you found this valuable, subscribe now, because in the next episode, we'll dive into Why smart people invest in scams. See you in the next video.